Okay, the Russian invasion of Ukraine tilts the risks of the global economy sharply to the downside, warns our next guest. Paul Gruenwald is the global chief economist at S&P Global Ratings. Paul, always nice to get some time with you. So walk us through this. How much downside risk are you looking for here?
Yeah, great. Good morning. Great to be back on the show with you guys. Well, as you said, we just put out a report looking at the macro credit implications of the invasion in Ukraine. So we've got three channels we've identified to watch. The first is energy prices. Obviously, those are heading higher. That's good if you're a producer or an exporter, and it's bad if you're a consumer or an importer. Kind of net, that tends to be negative. So that's going to be a drag on growth. We also have capital flows. We know that in situations like this, many fund managers are de-risking, so we're moving away from riskier credits, whether those be on the corporate side, the bank side, or the sovereign side. That's going to tighten credit conditions. And then finally, confidence. We just heard some confidence numbers from February, but we would expect both consumer and business confidence to decline in the months ahead. So that means lower consumer spending and lower firm investment. So you put all that together, and we've got some material downside risks to growth. We just started our forecasting round, which we call the quarterly credit conditions round. So we don't have updated numbers, but we've already flagged to our clients and stakeholders that the invasion of Ukraine holds serious downside growth potential.
Paul, good morning. It's good to see you. It feels like there's a little bit of a disconnect here because you're painting a relatively dire picture. And yes, we have seen some turbulence in the markets here, but it doesn't feel as though most of the folks we're talking about are as concerned about the situation as the scenario that you're painting would seem to imply. Why do you think that is, or do you think that we're not sort of yet at that scenario, or it has to play out a little bit more, perhaps?
Right. Well, I think you answered it at the end there, Julie. It's very early days. And as I said, each of the channels we identified is going to have a negative impact on spending and growth. It doesn't necessarily mean, for example, that the U.S. is going into recession. Our standing growth forecast is for growth just below 4 in the U.S. and just above 4 for Europe this year. I mean, those will almost certainly be coming down. We don't know the magnitude right now. So I think it's a bit too early to say it's going to be, the effect on growth is going to be X. But I think directionally we know where we're going. And, that's going to feed into things like monetary policy as well. So again, we're digesting the data as they come in. We're looking at the macro credit effects, and we're going to continue to inform the market. I think it's directionally clear, but to your point, we don't know the magnitude yet. We're going to discover that, obviously, as the data continue to come in.
Paul, just given where things are now, in your models, do you see or do you project a quarter of negative growth for the U.S. this year?
No, we don't. Let's remember, we've got a roughly just under 4% growth forecast this year. That's double the trend growth for the U.S. Usually we think of the U.S. as kind of a 2% growth economy or a bit less. So, do simple math, that's about a 0.25% increase every quarter. So getting to a negative quarter would be a big drop. We do have a recession indicator from our U.S. team, and that's still at a very low level. So I wouldn't put the risk of a normal recession, which would be 2 consecutive quarters of growth below zero. I wouldn't put the probability of that very high. But again, we're going to be lowering the forecast almost certainly. But the recession scenario is still a tail risk for us.
Paul, what is your current inflation outlook? We got the PCE numbers today for the U.S. at least for last month, coming in 6.1% overall, 5.2% core. I'm curious, sort of with the Russia scenario and without, what you're seeing as U.S. inflation, and then also what you see as global inflation.
Right. So I think we need to keep two things really clear as we think through the Russia-Ukraine scenario. One is we will get a jump in prices in the short term. That will be led by energy and any of the spillovers for that. But going forward, and let's remember, monetary policy making is a forward-looking exercise, the demand pressures will be lower for the reasons I explained just a few minutes ago. So again, we don't have a new inflation forecast, but if you kind of put all that together, that to me would suggest that central banks are going to go a little bit easier on the normalization than they were, let's say, a couple of weeks ago. The inflation prints going forward will be a little bit lower, and I would expect the language to start to change, maybe away from kind of an aggressive normalization to something more balanced. Another way to think about it is if we were at, the textbook steady state right now in monetary policy was neutral. If we had a shock like the one we're seeing with Russia and Ukraine, central banks would probably be thinking about easing monetary conditions and lowering rates. So we've got to kind of overlay that with the fact that we were starting a tightening cycle. So, the prints on inflation are going to be high for the next couple of months, reflecting energy. But going forward in the way that central banks do their job, if they're looking into late 2022, early 2023, I would expect not just in the U.S., but globally, a more moderate pace of monetary policy normalization, or in a few cases, if we get into a bad scenario, that might even stop and reverse.
Paul, next week we get a jobs report. What's your projection, and do you expect companies will pause their hiring plans because of what's going on with Ukraine and Russia, but also a lot of uncertainty around Fed policy?
Yeah, well, Fed policy, I just addressed. I would expect some change in the language to acknowledge that inflation is still higher than the Fed wants, but also saying that the outlook could be a bit weaker going forward. So that might be a slower pace of normalization. The job market, we know we're in good shape. The unemployment rate's around 4%. We're creating 400,000 or 500,000 jobs per month. We don't think that's going to have a material difference in the report next week. That's going to be a bit backward looking. But again, I would be watching the confidence numbers going forward. We're going to get those before the actual macro number. If we start to see a big drop in consumer confidence and spending, and we start to see a big drop in firm confidence and investment spending, then that would feed back directly into lower job creation. We're not there yet in the U.S. We would argue would be sort of moderately affected by all of this, less than Europe, let's say. But again, watching the numbers going forward, directionally, we know where we're going. The next few prints should be pretty much on the recent trend, but then when the effects of the Russia-Ukraine situation start to feed into the data, then they'll probably get softer from them.
Paul, great to catch up with you and get your insight on all of this morning. Paul Gruenwald is Global Chief Economist at S&P Global. Thank you.